This is the homework for this week's current liabilities that we're going to cover. And it's pretty straightforward. The first assignment we have is Dillon's Corporation. They made sales of $30,000 and they're subject to 6% sales tax. So for Part A, let's just focus on Part A for now. Prepare the entry to record the credit sales. And so what you want to do is we're going to receive the money later. So we did the work, so we recognized the sales revenue, and based off of that we've generated sales tax of 6%, so $1,800, and we're going to pay them, and they're going to pay us in the future, so that's the accounts receivable. Now in Part B it says if it was a cash sales. So if it was cash sales, the corporation made cash sales of $20,670 at 6%. So we know that we received $20,607 from the cash sales. Some of that is sales tax, and so what do we have to do? Well, we have to back out how much of that was sales tax. So if you take the $20,607 and you divide by 1 plus the percentage for sales tax, so if you take $20,670 divide by 1.06, that tells you the amount of sales revenue before the tax. And so that's the actual revenue that we generated. The sales tax payable is the 6%. So if you took $19,500 times 6%, you would get $1,170, and the entire amount of cash would be $20,670. So that's how you work through these sales tax assignments. In the second problem, what we have is 3 transactions, and we need to show the journal entries for the transactions to record the initial transaction. So first we have February 2nd. The corporation purchased goods from their supplier for $70,000, $210 net 30. The invoice was paid on February 26th, so it was paid after the 10 days, so we can't claim the percentage discount. Unfortunately, we recorded the discount because we recorded it at the net amount, meaning we recorded it at the amount minus the discount. So we need to see what we do about that. The second transaction is April 1st. The company bought a truck. They paid $4,000 cash, and the rest they put on a loan. And the third transaction is they borrowed money from the bank using a 0 interest bearing note. So let's work through 1, 2, and 3 in order. This is for the initial transaction. So we purchased the supplies. We bought it, and we recorded it at net, meaning we're going to subtract the discount because I guess when they bought it they planned on paying it within 10 days, so they plan on taking a 2% discount. So that's $68,600. However, they didn't pay it till February 26th. That's after 10 days. So that means, you know what, they can't pay just $68,600. They have to actually pay the full $70,000. So the payable is only $68,600. So the other account we use is purchase discount lost. You could have done this a different way. If you did it using the gross method, you would have put the purchases and the payable at $70,000. Then if you missed the discount, no big deal. You would just do the accounts payable and the cash at 70. And if you took it within 10 days, then you would do the cash at a lower amount, and then the difference would be put on at discount taken. For transaction 2, we bought the truck. It's a $50,000 truck. We used $5,000 in cash, and the rest of it we put on as a note payable. So that one's pretty straightforward. And then the third one, it's a 0 interest bearing note. So it says we're going to get $83,000 in cash but we're not going to pay back 83. We're going to actually pay back more. We're going to pay back 92,000. The difference represents the interest we're going to pay, but we can't recognize interest until time has passed. And so we're going to put a placeholder there called discounts on notes payable of 9,000. Let's see Part B. In Part B, we want to look at the adjusting transactions, the adjusting entries that we need to make for these transactions at the end of the year. The first one is pretty easy to do since the purchase of the inventory was already paid, so there's no adjustment necessary because it's already taken care of. We bought it and we paid for it. The second transaction is the truck. So what we need to do is figure out how much interest we have. So it was purchased on April 1st. So April to the end of the year is 9 months. It's a 12% loan. So that means the 46,000 times 12% is for the whole year, but then we prorate it for 9/12. So the interest expense is $4,140, but we're not paying that interest. That's thunder out there, in case you're wondering. It's storming here. We're not paying them until later when it becomes due, and so we're just putting it as a payable for the time being. And then the third item is the zero interest-bearing note. So what that means is that from May 1st to the end of the year, time has passed, and so that represents the interest that has accrued. So we want to show the 9,000 as our total interest, but only 8 months from May to the end of the year out of 12. So $6,000 we can turn into interest expense, and we can reduce the discount by the $6,000 because the discount provides us with the holding place until the interest has actually been incurred. Our last assignment is for company McDaniel. So they have a $1.2 million short-term debt that's due the beginning of the next year, about on February 2nd. However, they decide that they want to refinance it. So they're going to issue additional shares of stock. That's going to give them $950,000, but that's not enough to cover the $1.2 million. So they're going to take out another $250,000 in cash to supplement that difference. So what we're trying to do is we're trying to show this disclosure for the refinancing that was completed after December 31st because it was done in January, but before the financial statements are issued. The financial statements will be issued on February 23rd. So we're just showing this for just being this is going to provide us with the full disclosure that we need. All right, so what we want to do is we're going to show the notes payable for that part of the loan. It's the $250,000 that we're going to eventually take care of with cash. Then the amount that we're going to refinance using the additional shares of $38 per share at $25,000, that $950,000, we're going to show that as the long-term liabilities because that's going to be supplemented. That's going to be satisfied with a long-term method. So this one is more just about presentation and providing full disclosure. It's not so much, not a lot of calculations. So I hope that was useful for you. Have a nice day.